going to read my entire bio, otherwise I would have sent you a shorter version. But okay, well, it's great to speak to mostly NYU students. I was there in just starting at the cusp of the last financial crisis, so I came to campus on 2009, and so it's somewhat deja vu. We're having this crisis now, and I came as an aspiring student to learn investing, and sort of NYU was instrumental in me getting on the investment path. And so my goal was to come on campus and hopefully inspire and motivate a few of you to select or at least choose your passion, whichever way it is. The purpose of today's talk, I think, is twofold. The first part of the talk is to discuss, just the process, how I think, and a case study letter that I'd sent Mr. Buffett in 2013. How I found the idea, the process of finding the idea, how it's done, and what it taught me as an investor. And I thought I'd share the learnings with the NYU Stone community, because the learnings have definitely shaped me as an investor, and shaped my own process and philosophy over the last decade. So with that, what I'll do is, I didn't formally prepare slides for this presentation, but I do have my old slides from 10 years ago, which I'll just pull up and share the screen. So I hope you can see the screen. Ryan, please let me know if you cannot see the screen. Yeah, can you see the screen now? Oh, okay. Let me just pull this up in full screen mode. Um, and sorry, just one second. This is the first time I'm doing Zoom, but so the name of the company was Kobayashi Pharmaceutical. It was in 2013 when I stumbled upon it. I just worked at Goldman Sachs for 2 years right after NYU. I left Goldman to kind of just be an investor, and I there was a competition, a value investing Congress competition, and I decided to participate in the competition. And so I was looking for ideas, and I came across Kobayashi. Kobayashi is a 125-year-old business in Japan at the time, unknown to me, but a company that soon became quite evident to me that it was a very high quality business. Um, um, Here, I sort of just summarize as to why Kobayashi caught my attention. The first thing was that despite it being a 125-year-old business in Japan, it was a $2.5 billion market cap at the time. It was virtually not really covered. It was covered by one or two analysts who were putting out like one-page sell-side reports, and I was like, well, here's a 125-year-old company which seems to have 50% return on capital, and it's not really covered. So, what was it? So, the key points here are, yeah, the company has 150 brands, essentially simple, predictable products, niche products, and their philosophy is to be a big fish in a small pond. Um, Now, big fish in a small pond is interesting if you can keep reinventing different small ponds or different niches and be the biggest fish in the small pond. And that's what Kobayashi does, is it identifies niches and then has the highest market share in that particular niche. Products that don't change. And that was the first thing that struck me about the company. Was here was a company where the products have not changed over 2, 3, 4, 5 decades, and that's the type of company, that's the type of characteristic that Mr. Buffett does look for. Moving on, the company had very stable high market share. So over many years, it was over 30, 40% in many of its core consumer products. Again, a test of its moat. High returns on invested capital, about 50%. Unlevered returns on equity, excluding cash, were close to 15, 20%. And customers in Japan, seem to love the product. Now, mind you, at the time, I had never used a Kobayashi product. It wasn't necessarily selling in Hong Kong at the time that I was living there. wasn't selling in Singapore. I wasn't living in Singapore, but very few products of Kobayashi were actually selling outside of Japan at the time. I think there was one or two products that was selling, but the company has literally 150 brands. And so the idea was that if this company can sell to the Asian consumer outside of Japan, there is a long runway for growth, which is very important for a multi-bagger characteristic. The third thing that struck me was, when you think about Japan, you think about value trap. You think about these men in suits, with big cash piles and doing nothing about shareholders, not thinking about return on capital, not thinking about value, economic add, those type of metrics. But Kobayashi was quite the opposite. It actually, specifically in its management philosophy, they compensate mid and senior level management tied to the EVA, economic value added model, which is, ROIC relative to the cost of capital. And as we know, cost of capital in Japan is very low because you have close to 0% rates for a very long time. And so if you can make 50% return on capital and your cost of capital is virtually zero, that's a very big spread. And so these guys, each time they enter a market, they're very focused on this economic value added. And that was rare, and that was primarily the reason it caught my attention. Was not only was it a company that had this great history that was not covered, that was 150-year-old, 150 brands, the stability of its market share, high returns on capital, and here's a company that seems to be talking the value Kool-Aid. Now, not just that, they were consistently buying back shares at seemingly the right times. There was no equity dilution. There was very good corporate disclosure. There's fairly conservative accounting, and management had skin in the game. The management team. It's a family-run business, but professionally run. Over 100 years, you've had 5 presidents. And finally, I mean, looking at the valuation at the time, as per my presentation, which is somewhat outdated. Well, it's clearly outdated, but the enterprise value at the time was about 1.8 billion. Now, you don't buy a stock for its trailing earnings or trailing cash flow. You're buying it for the future. And so this 8.2 EBITDA is somewhat misleading because it's really looking back. And as I said, the reinvestment opportunity looking forward was huge. And so what you were really buying a company at the time at less than more like 6 times free cash flow, because over the next 3 years you had increase in the company's sales, increase in the company's earnings, and minimum levels of capex and working capital. So the magic number here is you want to try to buy, if you could buy a great business, like Kobayashi at 6 to 8 times cash flow, it's a no-brainer. If you can buy it at 12 times cash flow, it's excellent. But if you can buy it 6 to 8 times, it's a wonderful business at a wonderful price. And finally, I think the one point that I'd like to highlight is when you're looking for ideas, Kobayashi probably missed a lot of screens. One of the reasons was they were divesting loss-making wholesale medical devices businesses, and because of that, sales was actually declining. So actually, here you have these companies whose margins were going up, whose cash flows were going up, but sales was declining. And because sales was declining, it would give you the impression that it was a very low growth or terminal decline type of business, which is not correct. What was in fact happening was that because of because it had a few different businesses and because they were divesting, the quality of the business was getting higher, while on Bloomberg or Capital IQ, you would see a decline. And then finally, and that's, let's just go through the next slide. Why did the opportunity exist? The opportunity existed because, here is, the Japanese stock market's extremely inefficient. There are, lots of retail investors, institutional investors, as a sell side analyst, don't necessarily have skin in the game. As I said, this was a company with one page or two-page sell-side reports, which I thought was ridiculous given the moat of the company, given the returns of the company, given the improving quality of earnings of the company. And so it was a misunderstood business. So the opportunity existed at the time. The company has a few different businesses at the time. I won't go into details about it. I would encourage you to read the annual report. But as I said, 150 household brands at the time, not very proactive selling to the Asian consumer. And as in Asia, there's about 4 billion of us. And so that's a very big market. And if a company can just capture a small slice of China, a small slice of Southeast Asia, that's a very big market, right? Like almost 10 times, more than 10 times the population of the United States. Um, and so my when I decided to what I after I submitted the idea for this contest, I was a finalist in the competition. I was the only Asia finalist, and it struck me that after I'd read 20 years of annual reports, that this was the type of company Warren Buffett should buy. It was, as per this slide, it wasn't your typical Japanese company. As I said, they had this proprietary management index indicator, the EVA adoption, which really stood out because, as I said, most Japanese companies value traps. They give you the image of a value trap, right? Things are changing, but back then, 2013, Japan was still very much considered a value trap. Succession planning was at the core of Kobayashi. There was a shareholder value creation through divestment of lower margin businesses. There was a history of dividend increases and timely share repurchases. And so, what I decided to do was, um, what I decided to do was send. Uh, can you see my screen still, Ryan? Okay, great. So what I decided to do was send Warren Buffett a letter. It was a crazy idea, but then I thought about it and I said, well, the margin of, the worst thing that can happen is he wouldn't reply to the idea. But it was like 20 Hong Kong dollars. It was like one or two US dollars to send the idea off. And I thought nothing of it, and I said I've already done the write up. So I wrote to him saying, I'd like to bring to your attention this company, and I think you should take a look at it. And I didn't expect to hear back, but lo and behold, after a few days, Mr. Buffett, through his assistant, I heard back saying, Sid, it's a good company, essentially validating some of the points that I've made, which is that Kobayashi was a hidden jewel, which was not covered by analysts, which was a great company at a great price. But he says, we're looking for companies like this that we can buy control of on a friendly basis. Of course, keep your eyes open. And so that was quite motivating. Essentially, Mr. Buffett saying that we're gonna buy the company outright, and Japanese companies are not for outright sale because Kobayashi is too good a company and they wouldn't sell, right? So keep your eyes open, and that was very motivating and inspiring. But the key lesson transpired over the years, and that's part of the discussion that I'd like to have with you. Now, looking back at Kobayashi, this company uh, ended up over the last 6 years going up four times. The company substantially beat the Nasdaq, substantially beat the Dow and the S&P, and beat all the Asian indices. Um, so the learning I had from this particular case study, and why I want to share with you is number one, I would not necessarily pay attention to what others are saying, or a sell side report, which you would never have come up with the idea if you'd read a sell side report, right? Sometimes great ideas are just out there in plain sight, right? You just have to do your own work and look for a great business at a great price, as long as the company has a runway for growth, which Kobayashi did. And so, looking back at the performance of the idea, I think the takeaway there was that when you find a company or a business with such characteristics, a wonderful price, a wonderful capital allocation, a wonderful price, um, you ought to want to own it for the very long term. And that was a big learning experience because frankly, I bought Kobayashi and I sold it after it was up a bunch. Thinking that one can time the market. But the lesson here also is that when you find a company with such characteristics, you want to own it for the very long term, because a good company always keeps giving you good surprises, and a bad one always gives you, bad surprises. Now, I'm gonna at this point pause, and I'll let Ryan ask me questions because I can keep talking, but I think the purpose is now just to have a Q&A session with Ryan and all of you on some of the points that I've said, and perhaps dig deeper into the process, career advice I can give you all. Yeah, I think, Ryan, that's a very good question. And firstly, I'd like to thank Ryan Snope, who's done a fantastic job organizing this event amidst really challenging circumstances. So he really, like, hats off to you, Ryan. I need to buy this. I need to buy Ryan a very nice meal next time I'm there. And really, I'm glad to see, NYU students being, still looking at this crisis as a learning opportunity. So thank you, Ryan, there. To answer your question, I think that when you're passionate about something, it you know it. And for me, and I don't think I'll be very surprised if every single one of you wants to be an investor. And that's not the point of this discussion. The point of the discussion is when you find something that you're truly passionate about, no matter what it is, whether it's investing, whether it's corporate finance, whether it's private equity or consulting or being an entrepreneur or tech, um, you should listen to Charlie Munger's advice. And Charlie Munger's advice is take a simple idea and take it seriously. And so for me, it clicked because I felt passionate about investing, perhaps as early as when I was 18 years old, at the time of the 2001 dot-com bubble. That's when I got started as a private investor. I didn't know much about fundamental analysis, and I was hooked to the markets. And so what changed is in 2008, the financial crisis, was an amazing experience because I was an analyst at Merrill Lynch, and at the time, I think that we were seeing pretty much sell days every single day for 12, 15, 18 months. It was chaos, but I found that environment really resonated with me because as stocks were going down, I thought that there was great opportunity. And so I actually flew down to Omaha from Hong Kong, and I started reading all the letters from the Buffett partnership days, and it really hooked me. And it might not do the same to other folks, but for me, it was a time, I remember very excited about it. So when I came to NYU, I decided I would do everything to just um, make this an MBA in investing. And so I joined the Michael Price Student Fund, which was my highest grade. I was, a very passionate member of the Michael Price Fund, almost a bit too passionate. And the second, I would say, is that I interned for a great guy called Jeff Graham and Andy Spiz. Andy Spiz is a MBA Stern alum, 1996. Andy was a partner at Bandura Partners. It's a value investment firm in New York, and I was an analyst there during my MBA. I was looking at these small mid-cap U.S. stocks. Um, and that was a great opportunity because I was getting an MBA and then I was interning at this hedge fund with guys who were very experienced, and I learned a lot. So I made the most of it, and I would say that Ryan, you know, you know what you're passionate about. Don't be honest with yourself. If you're not passionate about investing, I'm not going to judge you. I think that's perfectly, it's very important to stick to kind of what you're passionate about, and then take a simple idea and take it very seriously. Yeah, it's changed significantly, I would say. I would say that, you know, I used to be this guy, loved finding this hidden small cap that was out of the radar, out of, being the first shareholder, and all that's great. But I've evolved to finding what as I said with Kobayashi, three things. The first is a wonderful business. What is a wonderful business? A wonderful business is a company that has a few characteristics. The first is that it is a niche. It has a niche and it's specialized, it's focused on its core competency, right? That's important, right? Second, it has a reinvestment opportunity that you can reinvest large amounts of capital and you can reinvest that over long periods of time. That's a great business, right? You don't want a limited amount of capital and just reinvest it just for 2 3 years. That's a value trap. So reinvestment is a critical part, right? I encourage you all to read this book, 100 Baggers, um, which will reinstill that point. The third is that it's a cash cow. Business, it's a cash cow. You don't want businesses relying on outside funding, etc., all the time, because the music will stop at some point. And really, the fourth is you want a business with pricing power. NYU has pricing power, right? So you want a business with pricing power. So I changed from being a very deep value, small cap, cigar butt type investor to one that looked for these types of businesses, because the big money really is made with that type of opportunity. And I think it's a natural evolution for a lot of investors, but it certainly was for me. Yeah, I don't have the exact number with me right now, but I would say it's probably half half. There was definitely multiple expansion, and the multiple has gone crazy. I mean, it's now I think like a 35 times earnings or 40 times earnings. So there was probably, I would say, two and a half multiple expansion, and then the rest, I wouldn't say revenue expansion is not the right way. It's earnings growth, right? So there are two legs of a stock. One is earnings growth, and the second is multiple expansion. Ideally, you want both, right? When you're looking for a stock, you'd like both legs to move, right? So Kobayashi had that multiple expansion because what happened was there was greater clarity on the quality of the business. There was more transparency in its filings. There was growth in the China business, which wasn't the case before, and more people became aware of it. So I would say it was more multiple expansion, but definitely one and a half probably earnings growth. Yeah, the Chinese have a saying that the Chinese have this saying that maybe live in interesting times, and we certainly do live in interesting times, right? Like, I mean, 2000 was as I said, I was 18 at the time. Then 2008 was interesting, and now clearly the sell-off has been extremely sharp and sharp. Um, Sorry, Ryan, can you repeat your question? Portfolio construct. I think the goal of a portfolio manager, at least my goal, I run personal capital. Right now, I run personal capital. I was a senior investment professional, prior to this, running and managing a team and whatnot. But I've since retired from that. So I'm currently running personal capital. So this is a disclaimer. I'm not giving investment advice. This is for informational, educational purposes only. Um, the job of a portfolio manager is to have a list of companies that are high quality businesses, know them really well, make sure that the businesses are in the hands of fine capital allocators. And then the job of a portfolio manager is to buy them when Mr. Market provides a great opportunity. Because stocks, as you know, unlike real estate, unlike liquid investments, move. And, that was a central tenet of Benjamin Graham, right? Chapter 7, sort of, saying that stocks move up and down. And so your job is to make sure that you've done the work. And when there's a crisis, like now, you know where to allocate more capital. And so I believe, at least my job, the way I invest is a concentrated portfolio. I mean, it depends on how much money you run, right? If you run, as much money as Mr. Buffett does, you clearly are limited to just large caps. But a concentrated portfolio of great businesses run by great managers at great prices and um, businesses that have pricing power, etc. That's the dream of a portfolio manager. So I don't think I'm telling you anything that's rocket science. Really, that's really what you're trying to solve for. I think that there's obviously we can go into depth about cash allocations, fixed income, hedging, short selling, etc. But to keep it simple for a long equity fund, you're looking for a concentrated portfolio of high quality businesses at great prices run by great people, and just make sure you know the businesses really well. Ryan, I see there are some other questions also on the chat, and I just want to be responsive. If you don't mind if I take some of them. Okay, so KY has asked, and KY is actually, KY said, how can we keep learning continuously after MBA? How to maintain a steep learning curve for a long time? So here's what I would say for MBA aspirants or investing aspirants, right? The first thing is really just know that investing is a lifelong journey, right? If you think you know it all now, like I would say find another job or find another career, because investing is a great way to get yourself humble. Mr. Market will find a way to get you humble, right? So it's a lifelong journey, right? I still have my notes from 10 years ago when I was like learning about fundamental analysis, and they were really detailed notes from every single book I read, every single accounting footnote, how, different revenue recognitions work. I still have it and I still refine it over time. I still have those notes from 10, 15 years ago. So it's a lifelong journey. And what you want to do is get your fundamentals correct, right? As if you're a fundamental investor, and I am, so I can't give you advice on momentum trading, algo trading, short selling. I can't give you advice on those things, right? That's not the purpose of this talk. The purpose is get your fundamentals correct. That means it's a lifelong journey. What you learn at Stern, what you learn at Columbia, what you learn in these top schools, you learn the fundamentals. Then you want to refine that. Second, you want to maintain a core list of companies and competencies that you think you can really add value on. So if you're a tech investor or internet investor, you want to make sure that you develop that expertise, and you want to be in the top 10% of that particular industry or niche, right? Like, you don't want to be the 50th percentile on a sector that's very well covered, right? Kobayashi was not very well covered. If it was, it would be trading at 40 times earnings at the time I found it. So you want to identify your niche and you want to bet big on that, right? The other thing you want to do is you want to maintain a network of smart investors, right? People who think differently to you, people who read a lot. You know, Charlie Munger says you're the average of the 4 or 5 people that you spend the most time with. So you want to find those people. If you really want to be, you want to find, and you want to uh, develop that network. I've spent a lot of time developing that type of network. So I think those things are um, very very important. I read another question saying, what are some of the most important skill sets and qualities to become a value investor? You know, I think I've discussed the fundamental side, right? So I'm not going to discuss that. But I think what surprises most MBAs, and what surprises, if you're undergrad, you're young, you're learning, I mean, that's fine. What surprises some of the MBAs and surprised me was that the most important thing I think in investing is not your ability to crunch cash flow statements and accounting footnotes. That doesn't necessarily make a great investor. It is an important characteristic, but it doesn't uh, guarantee that you're going to have great returns. There's tons of data on how great analysts and great fundamental are terrible investors. What really differentiates and what really makes one a great investor, well, besides the 3 things that I listed, you're looking for a great business, you're looking for great managers, you're looking for a great price, you're looking for to have your fundamentals. What really differentiates great from good and average is your emotional temperament. Your emotional temperament is something that's ingrained in you. It's in your DNA. You're either a very excited Mr. Market, or you're cool and calm and know exactly the businesses, the intrinsic values, and you're able to react without emotion. That's the most important thing is really I wouldn't say the most important thing. Clearly, you need the fundamentals, but the temperament is very, very important. Can you change it? I think you can. I think you can. You can work on it. I think you can work on it, right? I think it's possible, but it requires effort, right? Some people never get there, and that's why there's tons of literature, great analysts, great MBAs, great and terrible investors. It happens all the time, right? Because really, it's the emotions that get the better of them. There's a question, what does your typical day look like? My day is pretty boring. You wouldn't want your day to look like mine. I'm reading annual reports most of the time, looking at stocks most of the time. But then again, I'm very passionate about investing, and this is my passion, and so I don't recommend you spend all your time looking at annual reports. But reading annual reports, reading reading industry competitive annual reports, speaking to a network of intelligent friends. I think Mr. Buffett, back in when he was in his 30s, 40s, he had a core group of people he would speak to every now and then. So develop that network, invest in your network. I think is very important. Um, Ryan, you want to shoot off some questions? Well, part of the reason I moved to Asia, I had job opportunities in the United States, but I looked around myself and I said, wow, everyone's so smart here. Everyone has nice, fancy, shining MBAs, and so I was like, well, Jeff Grant, who I worked for at Bandera, teaches at Columbia, and a lot of very smart guys, and they struggle to sometimes beat the S&P, and they struggle to beat the Dow and the Nasdaq. And so I was like, well, in life, you want to obviously be in a market that provides, sorry, I'll come back to the passive question, but you want to be in a market that provides growth opportunity. It's big. There's the reinvestment opportunity, but you also want to be in a fishing pond that is less competitive. If you're really competing with really competitive, very, very smart guys, the likelihood of things being mispriced is low. Then your competitive advantage really comes down to the duration of your capital, right? And some fund managers have larger duration than others. Mr. Buffett obviously has a huge moat because of his, the way Berkshire Hathaway is structured and float. You and I can replicate that, right? Seth Klarman has a huge moat, right? Despite perhaps mediocre performance, at least in the short term. Now he's a fantastic investor, a great mentor. We've learned a lot from him, but his investors are very long term, right? They're not going to give you and me money for 10 years. So I think that your moat becomes different in some of these markets. It's different. Whereas in Asia, the I'm competing against who knows, maybe a Korean housewife or a Japanese housewife and a Chinese retail investor who doesn't know what cash flow and balance sheets are. So it's important to identify your niche, identify what you're really good at, then bet your career on it, and really take it seriously, right? Coming back to the passive investments, why was I giving this preamble before? Because really, in some way, it is also competition, really, because there's a move towards more and more passive, which means more capital is like, well, why should we pay you 2 and 20 or this and this fees if we could just, because 90% of managers don't outperform the market. So it's definitely, I think, the long-term outlook for fund management as an active analyst, etc. The field will keep narrowing. The field has to keep narrowing, right? That's one part of it from a career perspective. I mean, that's not to discourage people don't pursue active invest. There's still plenty of opportunity. The second part is really these indexes cause all sorts of distortions, passive index, cause all sorts of distortions in the market because, and I think Michael Burry, is out there saying that there's a bubble due to passive, and there's got to be truth in that, right? Because you're an index, you're just supposed to buy whatever the index, and and that's irrespective of fundamental analysis. So clearly, that does distort prices and does distort fundamental analysis, but over the long run, what doesn't change is it a great business? Is it run by great people? Is it a great price? Right? Yeah, sure. No. Yeah, it's a great question. I think sitting in New York or sitting in Boston, which is where I am currently, or sitting in San Francisco, investing in a Vietnamese or a Chinese company or a Indian company for that matter, it's far, right? Like there's a lack of trust. But remember, a crisis or not perfect governance is also an opportunity because in the stock market, when everything's nice and hunky dory, right? The prices typically reflect that, right? So corporate governance is something I take very seriously. As I said, the second part of my process is exactly that. I scrutinize incentives of people, right? So what is the incentive for you all to listen into this particular talk today? The incentive really is to learn, right? Because you're trying to learn as a student, and that's why you're joining on the Zoom chat, right? I imagine you have other things to do. Um, Incentives are a very powerful driver of the way human beings act and behave. And what I do is I scrutinize the incentives of management, which is through their track record, which is how did they allocate capital, right? What was the reinvestment opportunities? Were they able to maintain share? Were they, how is their R&D investments, right? Like what is the compensation structure look like? How is the culture of the firm? How do they treat people during times of crisis such as this, right? You look at the accounting earnings quality, and that's a very important second piece of the puzzle. And very few companies would score extremely highly. That's not to say you're looking for a 10 on 10. Like a 7 on 10 in China is actually very good, right? And therein lies the opportunity that some foreign investors sitting far away might say, oh, it's not a 10, I'm not going to invest. Well, if it is a 10 on 10, it's going to be at 6 times sales or 5 times sales. So um, I think there's different degrees of corporate governance and different expectations, but as what my goal is to have a short list or a narrow list of high quality businesses with great capital allocation, about 100 to 150 of them over a period of time. And remember, there's about 10,000 companies listed in Asia. More than 10,000. There's 15,000, right? So I just need to look for 50 to 100 great businesses and great capital allocation. And you wait for a crisis. I'm not saying you only wait for a crisis. Clearly, you're going to be sitting in cash for a long time. But um, if if you're concerned about capital allocation, just move on. Just move on. There's plenty that you can find, a good watch list that you can develop that would meet the good business and good capital allocation. Then it really becomes a question of price. Um, so I would encourage like investors to have a very open mind, right? You cannot be of the view that, well, that's China, it's got to be terrible corporate governance. Well, guess what? China is 12 trillion, a GDP of 12 trillion, and it's growing at 6% every year. At least that's what the reported numbers are, right? You can make it 5%, 4%. The math, if you just do that type of growth rate, right, at 12%, and you grow it at 6%, China every 2 years creates the equivalent of Spain's GDP, Italy's GDP, etc. Right? Every 4 years creates the equivalent of Germany's GDP, right? France's GDP. So for someone to say, well, that China is terrible corporate governance, I'm not going to invest, there's a really missed opportunity. And that the same applies for Japan. Well, it's a value trap in most Japanese. Well, that's not true. I just illustrated that Kobayashi was a hidden jewel sitting right there, right? And in Japan, but beat the Nasdaq. And so the company clearly had very good corporate governance. So there's opportunity if you keep an open mind. I think that's very important. I think Munger says that he tries to avoid people who have lots of opinions without knowing the facts. And I would encourage investors not to like come up with opinions very quickly, but really, keep an open mind. So sorry for the long-winded answer. I hope it was somewhat helpful. Mm. Yeah, I think obviously I don't invest in the sub-Sahara, but you know what? If I had unlimited time and an army of 10 great analysts who are twice as passionate and twice as hard work, well, not that hardworking anymore, but I would definitely look, right? But the important thing is, remember, these are really frontier markets. You really want to, number one, be in the advantage is this movie has played out before in other markets, right? China was, 1980. I mean, China's GDP was, I don't know what it was. I don't have the number off the top of my head. You should look it up, but it was tiny, right? And China has just grown and grown and grown as being one of the miracles, right? So you'd imagine like 20, 30 years ago, we'll be talking about some other economy. It might be from the part of the world that you're talking about. And so, but the important thing is this movie's played out before in other markets, right? Consumers, whether they're in India or China or sub-Saharan, they need certain products. They need a cell phone. They need telecom. They need a bank. They need consumer products, toothpaste. There are certain essential needs. And if you know what's happened in other markets and you identify just even those type of companies where they're essential needs and pick them as long as management is competent and good capital allocators, right? Um, and then you factor in the currency risk. make sure balance sheets are fine. Currency risk obviously is a very critical part in investing in emerging markets. You don't want, I mean, this year alone, would you believe that Australia, well, Australia is down for the year, obviously about 25-30%, but its currency alone has declined 15-16% versus the US dollar. That's Australia. That's a developed market, right? Indonesia's rupiah is at 1998 low. So when you're investing in these very frontier markets, it's definitely an opportunity. But just remember, keep it simple. This movie has played out before. Every country needs a telecom leader, a bank leader, a consumer leader, etc. Just make sure it's at the right of the hands of the right capital allocator, and make sure that you're factoring in currency risk, balance sheet risk, sovereign risk, etc. And there's all sorts of risks, right? If you could find a great business like, say, Apple, which Warren Buffett says is a wonderful business, and I think absolutely is one of the best businesses in the world. If you can find Apple at a 7-8% cash flow yield, growing at low teens or whatever it's growing at, with huge pricing power, why the hell would you want to invest in a company in who knows? Let's call it, let's make it country A that has sovereign risk, currency risk, and you're getting a cash yield of 10 to 12%. It's just not worth it. So you have to look at, being an investor, unless you're really constrained by just investing in that country alone. My job is, although I only look at Asia for my own personal investments because that's what I know best, you have to consider what the opportunity cost is somewhere else. So I always say, well, if I can get Apple at 6 to 7% cash flow yield, is Tencent great at 5%, right? With the growth rates, then you have to make all sorts of adjustments. And I think it's very important to think about investing in terms of opportunity costs, right? Well, Asia actually has some of the youngest populations. I mean, I'm not talking about Japan. Japan, obviously, we all know it's aging crisis, which part of the reason perhaps Kobayashi is a good company to invest in. But India has a very young population, 1.3 billion. I don't know the real stat. I think it's about 50. There's a very high number that's below the age of 30. Vietnam has 100 million people. It has a very young population. I think over 50 or over under the age of 25. Um, there is, compared to the West, I would say Asia actually has compelling demographics. Now, I know things are obviously in Japan, it's different. China, because of the one child policy before, but they've changed that to now a two-child policy. So, China has its share of issues there, but I don't think it's a significant issue, not at least at this point. Um, I think clearly it is an issue in many countries, European countries. So I try to avoid countries where there is no growth. I mean, if there's no GDP growth and there's no growth, then it's a very it's a tough one, right? Like you want to find the most number of multi-baggers in Asia come from India. The most number. I mean, the list is longer than the United States. The second place is China, right? You could you could have 100 case studies just on 20, 50, 100 baggers in China and India. The list is longer than the United States, right? Um, the great thing about the United States is there's lots of fantastic businesses run by people who know how to allocate money because people are just, they've been trained to this school of thought. So um, you want to pick the right markets. And I chose to pick Asia because of that reinvestment opportunity. As I said, if China is growing 12 trillion, 6% a year, India's 3 trillion growing at 6-7% a year, Vietnam's growing at 7%. You want a country which is on the right trend. You want to find the winners in that, but you don't want to pay too much for them, right? That's really the goal of investing. Sure. Sure, no, I mean, I have time. A couple questions I see. What's a good way to diversify a portfolio for the coronavirus crisis? Well, diversification, Charlie Munger and Mr. Buffett say that is really for someone that is a know-nothing investor. And not to demean anyone, right? But the point is that if you really invest in, 15 to 20 great businesses run by great people and even pay a fair price, you should do well. So I don't recommend a portfolio of 50 to 100 businesses for anyone. Not that I'm making recommendations, but personally, I think there's a point where you don't want to over diversify, but really, whatever the crisis is, as long as you stick to a great business run by good managers, you'll do okay. Let me just look at some of the other questions. What are something we have to start training ourselves as an analyst starting from day one if you want to be a PM in the future? By KY. That's a very good question, right? There's no typical career path, right? It's not like investment banking. You join as an analyst, then you become an associate, then you go to business school, then you become an associate, then you spend 3 years, you become a vice president, then you do da da da. You are good at politics, and you become managing director, and if you're really good, you'll become partner. Things like that, right? That's not the way it works, right? Like from an analyst to being a PM, really, it's about results. It's about idea. It's about process. It's about um, um, what are the things you can do? Well, firstly, find a great firm, right? Find a great firm with a great culture. Uh, Find a mentor early on. I think it's very important to find mentors. It might not be at your immediate workplace, but seek them out, right? Like if you think I could be a mentor, well, try to schedule a call at least once a year, right? That's sufficient, as long as you have a quality 30-minute conversation. Find a mentor and really build that network. I think is very important. In this day and age, it's almost inexcusable for people not to be able to invest in like just develop a network. It's much easier now. So I think find a mentor early on, keep an open mind, just know that you are not the world's best thing to happen to investing, right? It's, everyone thinks that, oh, I'm going to be the best investor. I'm going to be the next Warren Buffett. Well, guess what? You're not going to be the next Warren Buffett. I'm not going to be the next. No one can be, right? There's only one Warren Buffett. And we don't need to think that we're going to be the next Warren Buffett. You just have to keep keep your mind open and read, learn, keep learning, keep reading, develop a process. As I said, I have my notes from 10, 12, 15 years ago about fundamental analysis, right? I could still refer to it, and just keep learning. Find a great mentor. I think is very, very important. Unfortunately, I didn't have a great mentor. I had to self-teach myself, which is part of the reason I'm doing this talk, is because for somewhat selfish reasons, because NYU is where I got my start. Second, I think the importance of having a mentor is just really important. For me, I kind of self-taught myself throughout the journey. And while I've worked at great firms, great cultures, and learned a lot, I think the best learning was just reading the partnership letters, Buffett, and just maintaining a network. So I think those are some of the points I would say in terms of a career. Um, I think, Tada, how do you think about, okay, fine. Any final questions, Ryan? Ah, Yeah, I think the first thing is, you know, um, I think the first thing is like really, you got to show that you're passionate about investing, right? Like as I said, my favorite class was the Michael Price Student Investment Fund because it was great because this was a live fund. I spent most of my time during at Stern, just at that class and my internship, and obviously I took some of the classes on financial shenanigans and whatnot. I was not a big fan of Damodaran's class. Although I love Professor Damodaran, and his passion is is great. So I think you got to stand out by number one, your passion, number two, your ideas. If you're going for an interview and you don't have write-ups of some of your best companies, even if it's not a stock you'd like to buy today, but if it's a great business and a great capital allocator, I'd love to read your analysis. So you have to come up with write-ups and keep writing, and they don't have to be 10 pages long. They should only be 2 or 3 pages long, but just get to the meat of the puzzle as to why it's a great business, why it's great management that has good skin in the game, why they're great capital allocators, and as I said, what makes this business great. And then if price is great, explain why the markets miss this opportunity and what makes the price great, right? So really you can cover that in 3 or 4 pages. It doesn't have to be 50 pages. Brevity, there's something to be said for brevity. So I think be passionate, have ideas, be ready to talk about ideas. If you have a personal portfolio, be ready to talk about the personal portfolio. I've interviewed over 300 candidates, 400 candidates over the last decade on for investing from all schools, Columbia, Harvard. And I remember this interview with this MBA candidate from HBS, um, which on paper looked great, but then I got into his personal portfolio and just asking him what his top stock was, and he couldn't remember it. He couldn't remember it, which clearly meant he was making it up, right? And so then I asked him about his second position, and he couldn't remember it. So clearly, after the third one, I figured out that he didn't have a personal portfolio. And so I think be prepared, right? If you have a personal portfolio, why do you own number one stock? What do you like? Okay, what's number two? Why did you size it up that way? I think folks that just are passionate, humble, open-minded, have idea write-ups, have a personal portfolio, and just explain why you own number one, number two, number three, number four, what could go wrong, intrinsic value estimates down, they would stand out clearly in an interview, right? And I wish someone told me that while I was at NYU, but I had to figure it out the hard way. But really, I think that that's what it comes down to. This industry, it's not about the the hierarchy. There's no like associate VP. If you're a 27-year-old, 26-year-old and have a great idea and it's well researched and you want to tell the world about it, well, tell the world about it, right? You don't have to wait for an MBA, or you don't have to wait for so what I started doing was I started writing my ideas. So after I left Goldman, that's exactly what I did. I wrote up Kobayashi and I sent a letter to Mr. Buffett. No one told me at NYU to do so, right? If you have a good idea, send it to people, right? Not necessarily Warren Buffett, right? But send it to whoever. Send it to, if you enjoyed some of the things I've said, send it to me. I'd be happy to provide you feedback. If it's a well crafted idea, send it to people, and you'll be amazed that people, if it's a well researched idea, you develop a network. And so, that's kind of my advice for MBA students looking to careers in investing. It's very different from consulting. It's very different from investment banking, which is very traditional and whatnot, which is why I was a terrible misfit for investment banking, and I would have made a terrible consultant. But that's kind of my advice. I hope that answered your question, Ryan. Yeah. No, no, no. I have time. Yeah. Yeah, I mean, look, that's a very good question, right? I've had significant influences along the way, but as I said, I was unfortunate that I didn't have a mentor. So it was unfortunate. So I take mentorship very seriously. You can speak to my previous analysts who worked with me and for me. I take it a bit too seriously because I really think that it's very important that people train the right way and develop the right skills, because it can have a fundamental difference to the person's career. And so I was probably on the extreme, because I was a very hands-on mentor, and hopefully I think influenced some of their careers. Um, I think for me, um, obviously, I just read the Buffett partnership letters 6 times. I think the first time I read it, I didn't understand much. I understood maybe 10%. So I read it again, read it again, read it again, and each time I just kept taking notes. And that's the thing, right? Like you can if you want to be the best boxing player, then you got to follow Muhammad Ali. If you want to be the best tennis player, then you want to follow the best tennis player, right? You want to be the best swimmer, then you want to follow certain people, right? You want to be the best golfer. There's you don't need to follow number five. You can follow number one. So what I did was, people asked me for advice as to what to read. I'm like, well, just go to the guru, right? There's just download all the letters and read them over and over and over again until you really understand them, right? And you'll never fully understand it, right? Which is why it's great to just read that over and over again. So start there. But then I had um, a lot of friends that I made in the industry, right? Which I learned a lot from. Jeff and Andy at Bandera were obviously very important influences for me getting started. Jeff, was on the board of this small cap company, that had this big cash pile, and he was getting them to pay out a special dividend. And I had not seen that type of investing, and so his book about activist investing was refreshing, right? I attended all these conferences and talks, and just absorbed as much as I could from as many investors. Two of the investors I really admire in Asia. One is Lee Lu. He is by far the one guy you want to follow. Unfortunately, there's not a lot about him in the public domain, but Lee Lu is exceptional, right? That's one guy. If you can get, your hands on at least learning something about him and his philosophy, his public interviews, read it. There's another manager in Asia called Richard Lawrence, who runs a $4 billion fund called Overlook Investments. Richard is kind of like the Warren Buffett of Asia. I mean, old school. I probably would disagree with many certain things of his investment philosophy, but back when he was investing in the late 80s and 90s, Asia was somewhat frontier market. I wouldn't say it's frontier now. Richard, has a great blueprint, and I must say I copied one or two things, meaning like from his public presentations where he has a process around the price, and I've evolved that over time. Um, I would say that there's learning opportunity in really not just from one or two or three or four people, not just the famous people. In fact, I would say almost avoid them, right? Just pay attention to the three or four guys that I talked about, but don't fall in love with, oh, Bill Ackman said this. Well, Bill Ackman's great, but you can't buy his conviction. You can't buy, David Einhorn's conviction. So you should not be going down that path. I lost a lot of money listening to some of those guys at Irason conference. Not a lot, but a little bit of money. Going to Irason conferences, investing in those ideas, they turned out to be some of the worst ideas. So it's just your friends around. Maybe it's a NYU classmate. Maybe it's someone at business school at Columbia who is a great, passionate stock pitcher. So, I have friends in different countries. In Vietnam, I've identified the best analysts there. In India, I have a list of the top three or four. In Japan, I have a list of three or four guys. In China, I have a short list. So identify people in different sectors, different countries, and call on them and say, hey, I saw this about this company, right? Like, I'd like to get up to speed. Could you share, and most people will be willing to share that. So I do that very often. And so I would say that perhaps I didn't fully answer the question, but I would say that try to learn as much as you can from the best people in their respective fields. Um, Yedu, I think that question was from you. So I think you asked, do you even need to talk to someone else for validation? No, don't look for any validation of your ideas, or, definitely look for counter arguments. You want to know what people, you want to know what the other side is thinking about a business. You want to know about the competitive. You want to don't ask a fund manager. Ask, like, let's say you're investing in Alibaba, right? Maybe you want to talk to JD.com as to why Alibaba is inferior to JD. If you're talking to JD, maybe you want to talk to Alibaba, right? You want to talk to competitors because they'll tell you the real story and maybe they'll exaggerate it. So I don't necessarily like to talk to fund managers about my ideas because, frankly, I know them better than they do a lot of times because I spend a lot of time on the particular idea. I would rather get the counter view from a competitor to a company that I invest in. Um, is investment team sport or individual sport? Yedu asked a very good question. That's a very good question. I think some folks, if you're really exceptional, Warren Buffett, Mohnish Pabrai, Charlie Munger, Lee Lu, it's individual sport. You don't want to put them in a team. Now, obviously, Berkshire has a great team, has that, but really, if you're exceptional, it's an individual sport. Michael Burry, it would be a terrible team player, right? This being said, to build a firm, you need to build people with a great team and a great culture who understand the key, things that you're looking for. So it can be a team sport and it can be done right. And there's some great firms. The firm that I worked for previously, Amiral Gestion, is a great firm with a great team and a great culture, and they've done a great job. You could go to Ruane Cunniff. There's other great firms. So it can be a team sport, but generally, my own style is I don't like to work in teams for investing ideas. I like to do my own work. If I was working in a team, there's almost a 0% chance that I would stumble across Kobayashi, right? So the point is that I think that you cannot buy conviction. I think, if you're working alone and find great ideas, that's great. Can you share some of the mistakes you made in investing? I think that's a very good question. This is what I thought was my best idea, and it turned out to be my worst ever idea. And I'm actually very happy I had that mistake early on in my career. Well, it wasn't that early on, but there was this company called Chuiwa in Hong Kong, which has been an absolute disaster, right? I came across Chuiwa much the same time I came across Kobayashi. It was a small cap, so there was nothing for me to send it to, Mr. Buffett. It's a fantastic QSR restaurant in Hong Kong. It's one of the best, right? The Hong Kong business is a cash cow. They just gone recently IPO and wanted to expand in China. Now, I extrapolated the Hong Kong success to China, and I basically said, well, they are a 2-year payback in Hong Kong. Maybe it's going to be 3 years in China. Even if it's 4 years, that's 25% return on capital, far exceeds the cost of capital. It's a great business. I extrapolated that to China, and that was a terrible mistake. Mistake number one, because that turned out to be completely inaccurate. The company botched up a lot of the operating, botched up their growth plans in China. It was a disaster. And the second learning was that pay attention to who the management team is. Chuiwa is a good management team, but the problem is there's too many cooks in the kitchen. There was about 5 co-partners in the kitchen. When there's 5 anyone in the kitchen, it's too many, right? And for a public company, it's too many. And so each one has their own different incentives, they're at different points in their career and life, and it tends to kind of not, it doesn't, it's too many, right? You have 2 people, it's fine, it's 5. So I learned that incentives and just paying attention to the structures of management teams is very critical as well. So Chuiwa was a disaster. It fell, probably 80%. But I'm thankful for that experience because you learn more from both your very big winners. I learned a lot from Kobayashi. I learned the power of finding a great business, the power of a great management, the power of a great price, and the power of holding it for the long term, right? Those are all learnings. But I also learned from Chiriwa as to how not to fall in love with an idea. I was in love with Chiriwa. I went to their restaurants. I knew all the waiters. I knew how much they made. I knew how long they'd worked. I knew probably 50 people at Chiriwa. I'd done all the work. I'd, tried up everything in the menu. And so it wasn't a lack of research, but it was I fell in love with the idea and I extrapolated earnings in a new market where they disastrously failed. I have had a few other mistakes. One was a retailer. Typically, most of my mistakes have come from that particular sector, which is why you'll never find a retailer in my portfolio. I tend not to buy retailers because a lot of things can go wrong. And it looks great in a bull market, and it's a disaster during when times are tough. Their expense structure, etc. So I tend to now know that I'm not very good at investing in a certain type of industry or a certain type of sector, and so I tend to avoid it. Any last one or two more questions? Yeah, why don't you ask one more if no one else has? Yeah, I think Yedu is just so you guys know, Yedu is not a NYU student, but he's a friend of mine. He works at Intel, and I'll be speaking at Intel in April. Yedu, that's a great question. I think it's tremendously beneficial to the NYU student community. So thank you for that question. I think, look, investing is not supposed to be easy. Charlie Munger says, well, if you think investing is easy, you're an idiot, right? If you think you're the best investor in the next, you're an idiot, right? Um, and I think I'm trying to be helpful by making those comments, right? So when you're trying to, when as the goal, as I said, of a portfolio manager is to buy uh, great businesses that you know well, that are widening your moat or at least not declining, and great managers at great prices. That's the goal, right? That should be the goal. And then you want a sufficient amount of diversification, not excessive, perhaps 12, 15, maybe 15 names, right? I think anything beyond that, personally, my personal style is too much. It again depends on the level of assets. Now, averaging up, look, every day, right? Your moat, every day you wake up, every month, every year, every 3 years, every decade, you're changing. The same thing happens with companies, right? Your moat is either increasing in your company or it's decreasing. You're either more valued at the companies that you guys join after business school, or it's declining, right? We live in a dynamic world, and so companies' moats are increasing over time. And it's very dangerous to be buying averaging up in a company when its core competency is actually being eroded. And that's why Warren Buffett says, well, I like a business that has this huge castle. Well, if it has a huge castle, fine, it's okay to buy more. Now, some people find it hard to buy more when the stock rises. I used to. I don't anymore. I used to. I think it's perfectly fine buying more of a great business. But I think what I would say is that you should refer back to a 1970s letter in the Berkshire Partnership letters, where Mr. Buffett talks about probability bets. That's probably one of the best letters in my view. It talks about how one sizes positions. and probability based investing. And so, Yedu, what I would suggest is you go through the same exercise. You say, okay, he's looking for a 10 percentage performance alpha over, the Dow. So say, okay, this idea, okay, what is the downside if I'm wrong on da da da? Okay, what is the downside, right? And then what is the upside if I'm, taking a view on X, Y, and Z? And okay, and then if you make an assumption that the market typically goes up, say 7, 8, 10% over the long run, just look at Jeremy Siegel. He tells you some things. I don't believe half the things he says, but just there's data on what the stock market does over, and then say how much. What is your goal as an investor? How much are you trying to beat the market, right? Are you trying to keep up with the market? In that case, just buy the index. So depending on what that number is, then you can compare and contrast the probabilities of success for each of those investments. And it depends on really the upside and downside. So really, you want to constantly evaluate that. If you find a much better idea that gives you a better probability upside downside, then I don't think it makes sense to average up a idea that is has lesser mathematically it's less attractive from a mathematical perspective. But then again, I think it's perfectly fine to average up companies that you know really well, right? Because part of the process also is to buy what you know, as long as they are good businesses at relatively fair prices run by good management. What you don't want to do is sell something you know and then buy something you don't know, because when the price goes down of something you don't know, you won't know whether to buy more, right? So I think there's also merit in having a portfolio of businesses that you know really well, and that's why specialization, I think, to some extent is important. That's why I specialize or I look at Asia. I'm not a specialist. I wouldn't really call myself an expert, but clearly I would know more than someone than Bill Ackman, right, on Asia, right? I should, because that's I've been spending my career on Asia. And so I think, yeah, to your point, I think it also comes down to like how well do you know the company, because you want to sleep well at night. You don't want to own stocks where you're looking at the price all the time. And so it's a fine balance. Yeah, Chung Hei, I mean, good to hear from you. I know Chung Hei, he had recommended an analyst that worked with me and for me, 2 years ago, well, a year ago. So, I discussed this earlier, Chung Hei, but just for your benefit, right? Um, my current process is I look for a great business, good management, great price. I think everyone says that, but I have a well-defined watch list of businesses that meet one and two. Which I could go into more detail if we did another talk at some point. That's my process now. Companies like Kobayashi are on that watch list, right? Companies like Chuiwa are not on that watch list because they're not a great business, right? So how has it evolved over time? When I was at NYU, I think I used to gravitate towards a lot of these 100, 200, $300 million businesses. And that's great. And you might double your money sometimes. I hope sometimes you find a small cap like 10 cent or NetEase that becomes a 50, 100, 500 bagger, right? But those tend to be, well, great investments if you hold on, right? But most small companies tend to stay small companies. Most small companies. Now, you could look at Tencent and Walmart and Intel and all these companies and say, well, well, not everyone makes it big, right? So the most important thing I learned was that you want to, well, if you're looking for a small company, that's great, but make sure it operates in a pond that is necessarily big and it has the expertise to actually capture that, right? So Tencent was the gift that kept on giving, right? If you own Tencent for the last 15 years, you know, um, uh, well, that's fantastic, right? If you owned it for 10 years. So you want to be looking for, so I've evolved in the sense that I've stopped looking, I will almost pass a company that is very cheap, and I know it's going to make money because it's just dirt cheap, like 3 times cash flow, 2 times cash flow, but it's illiquid and there's no opportunity to reinvest the capital. I'll pass on that. There's hundreds of companies I can name that are in that type of bucket, but that's not for me. Some other fund managers or some other investors would invest in that type of company, but not for me, because the problem in that type of investing is what you call reinvestment risk. And this is a very, actually, I'm very glad you asked the question. I'm very glad I can re-answer this question. Is reinvestment risk is a significant risk. What is reinvestment risk? A company that does not have a long runway for growth is, say like a company that can double, but then you have to sell it and you have to find another company, is actually detrimental to your health and your returns for the following reasons. The reasons are that you have to find another idea, and the more decisions human beings make, because we're creatures of fear and greed, and because we're emotional creatures, you're going to make mistakes. And you will make more mistakes with that sort of reinvestment risk. And typically, that reinvestment risk happens when you're investing in a small company that tends to stay small, is just cheap. You buy it, you make some money, and then you have to find another idea. Well, the more decisions you make, the more mistakes you're going to make, right? So you want to narrow it down to great businesses that have that long runway. Now, that's not easy. I'm not saying it's easy, but that's the goal. That's what you should. And that's how I've evolved, because I realize I want to sleep well at night, and I want to own great businesses and let them do the work. And I want to be investing in companies that have great managers. And you know this because if you look at a 15-year track record, you will know that a certain company has uh, grown at a certain rate. They've increased market share, they've increased prices, or they have taken care of their employees during tough times, or they have repurchased stock at the right time, or they repurchase stock at the wrong time all the time. There's a track record. It's much like a CV, right? You want to analyze a CV of a company. And so I've evolved in that sense. And that has been, I wouldn't underestimate just that learning, because, you can only evolve if you keep an open mind. If you don't keep an open mind, you'll be investing in those small caps and reinvesting, and that creates, when you're young, I think it's fine. As you grow older, you want to make fewer decisions, because really the big money is made in identifying those great businesses, having that reinvestment, and being able to hold on to it for a long time. You're not going to get a 100 bagger in 2 or 3 or 4 years. I mean, you'll be lucky if you get a 20, 50 bagger, right? But the key is to hold on to it. And you can't hold on to it. You can't hold on to an average business. That was the big learning takeaway I had, and that's why I decided to present Kobayashi as a case study, because, and I got Mr. Buffett's consent to talk at NYU and Intel about this case study, because I felt that, firstly, I would learn from the talk myself, and secondly, if there's one takeaway, is you want to buy good businesses like Kobayashi, right? Like Apple, right? Businesses that are cash cows. Like Apple sits on $60 billion of free cash flow every year. It's huge, right? Apple's repurchased and paid out dividends more than the entire Indian stock market. Entire Indian stock market, right? That's a great business, right? So it's no wonder that Mr. Buffett owns a lot of Apple, right? So that's how I've evolved, and I think we probably overextended our time. Ryan, I'd like to thank you for really organizing this talk. It was very helpful. For anyone that wants to reach out to me by email, you could certainly reach out to me. Ryan, did we publish my details or contact details? I suppose I'm on LinkedIn, so you can contact me via LinkedIn, and that would be great. Or you can contact me. My personal email, it's just sid.choraria@gmail.com. You can contact my personal email, and I'd be happy to engage or help folks and stay in touch. And I wish you all the best in your investing careers, or any career that you're going towards. Tremendous. Okay. Well, thank you very much, Ryan. Should we conclude? Yeah. Great. Thank you. No worries.